Let's go through another example. Cha Limited rents heavy equipment and reports $750 of pre-tax financial income in 2001. During 2001, they collected $120 of rental payments in advance. Rental amount is taxable when received, but the revenue will be earned equally over 2002 and 2003. Cha also had $50,000 of interest revenue from municipal bonds in 2001. Tax rate is 35%. So we have two differences here. The first is we collected $120 of rental payments in advance. So when this happened, we collected that $120, we would have debited cash for $120,000, and we would have credited unearned rent revenue. Right. For book purposes or for counting purposes, we can't recognize that revenue until we earn it. And it tells us we'll earn it equally over 2002 and 2003. So over the next 2 years, we'll recognize $60,000 of income in each year. So in this case then, that means in the current period, our taxable income is going to be higher than our accounting income due to this temporary difference. The second difference here is we have $50,000 of interest revenue. This is a permanent difference, which means it will be included in accounting income, but it's never going to be included in taxable income. So again, the first step to solving any types of these problems is to figure out what your taxable income is. So we have $750 in accounting income. We're going to adjust that first for the rental payments. So the rental payments, it's taxable when collected. So that means in 2001, this whole $120,000 will be taxed. It'll be included in taxable income. So we'll include this $120 here to reconcile accounting income to taxable income. Second part here is, since we're recognizing this $120,000 of income for tax purposes now, that means in future years, our taxable income will be $120,000 lower. So since it tells us we'll earn the revenue equally over 2002 and 2003, that means in 2002, from this originating difference of $120, our taxable income will be lower in 2002 by $60 and another $60,000 lower in 2003. So in total, we have a future deductible amount of $120,000. Second thing we need to adjust for here is for our interest on our municipal bonds. Again, this is our permanent difference, so it's going to reduce our accounting income to get to our taxable. Right, and so if we subtract out the $50,000 and add in the $120 to accounting income, we get out to $820. So at this point, we can calculate both our deferred taxes and our income tax payable. To figure out our income tax payable, or our current taxes payable, we can simply multiply the $820 by the tax rate of 35%. Right, so we'll get out to $287, which tells us we can debit income taxes payable for $287. Okay. In this case, since we have future deductible amounts, we're going to end up recognizing a DTA, or deferred tax asset. We'll take the future deductible amounts of $120, we'll multiply it by the tax rate of 35%. So that'll get us out to $42,000. Again, the journal entry we make here for deferred tax assets or deferred tax liabilities is the change in deferred taxes. For this example, we'll just assume we have a zero beginning balance in our deferred tax asset. And in this case, we're trying to get to an ending balance of $42,000. So to get to an ending balance of $42,000, we'll make a plug here for a debit of $42,000. Okay, so this is our plug. So since we made a debit here to DTA, we'll also make a debit in our journal entry to reflect that increase. Okay, and then the final part of this is we can now plug in our income tax expense. As we learned earlier, our income tax expense is the income tax payable of $287 plus or minus the change in the deferred taxes. Easiest way to do this without trying to get confused of whether to add or subtract the change in the DTA or the DTL is just remember that our debits must equal our credits. So our debit here to income tax expense will be the $287 minus the $42,000. So we'll get out to $245. So let's continue this example and then go into the next year. So now it's 2002, and it tells us to assume we have a taxable income of $900,000 in 2002, no municipal interest. So in this case, we're directly given taxable income. Again, if we're assuming the same tax rate as before, which is 35%, we could go ahead and calculate our income tax payable in 2002. And given we could calculate the future deductible amount, we could also calculate deferred tax asset. Given this information, though, we should be able to back into what our accounting income is. If you remember the details of the problem, we have $120,000 of rental income we recognize for tax purposes in 2001, and for book purposes, we'll recognize $60,000 of that in 2002 and $60,000 in 2003. Right, so that means for book purposes, our income is going to be $60,000 higher since we're going to recognize $60,000 of the rental income. All right, so we can fill in accounting income from that. For taxable income, we'll multiply by the tax rate of 35%. And so that gets us out to our current taxes payable of $315. So again, for 2002, that tells us we are going to credit income tax payable for $315. Right, second part of this is we'll figure out the change in the DTA. So our future deductible amount here, since we're going to recognize $60,000 of the rental income for book purposes in 2003, that means taxable income will be $60,000 lower in 2003. So we have a future deductible amount of $60,000. Again, we can multiply that by the tax rate of 35%, and we get out to our desired ending balance in our DTA. So at the end of 2001, we had a $42,000 balance. Now at the end of 2002, we would like a $21,000 balance. So we'll make another plug here to get from a $42,000 debit balance to an ending balance of $21,000 in debit. We would have to credit our DTA for $21,000. So we'll do the same thing here. We're going to make a credit in our journal entry for $21,000. And then the last part of the journal entry is to fill in your income tax expense. Again, we already know debits must equal credits. So our debit to income tax expense will be the $315 plus the $21,000. And that gets us out to our ending journal entry for 2002. Just to finish up with this, let's go into 2003. So in 2003, now let's assume we have a taxable income of $940 and no municipal interest. Again, for book purposes, we're going to recognize the last $60,000 of rental revenue. So our accounting income will be $60,000 higher than our taxable income. So our accounting income will be $1 million, and our tax rate, as before, will be 35%. So that tells us again for 2003, we're going to make a credit to income tax payable for $329. And then again from there, we need to figure out what our desired ending balance in our DTA is. So I'll just carry this down here. So at the end of 2002, we had a balance of 21,000. Right, and then at the end of 2003, this temporary difference from the rental income has completely reversed at this point. So we'd like an ending balance of 0. So again, to get from a debit balance of 21,000 to a debit balance of 0, we would make a credit for 21,000. And so we'll just credit in the journal entry DTA for 21,000. Right, so that means, again, we'll fill in income tax expense last. Debits must equal credits, so the debit to income tax expense must be the 329 plus the 21,000. Right, and that gets us out to our ending journal entry for 2003. So as we saw in the last example, if we have future deductible amounts, it results in a deferred tax asset. Right, so pretty much a deferred tax asset just means hopefully we're going to be paying less taxes in the future. However, if we're going to be paying less taxes in the future, it's necessary that we actually generate some net income. So we're actually taxed on some income, right? Because if a company reports a net loss, it ultimately won't pay any taxes on a loss. In some cases, however, not all companies are going to operate at a profit in the future. So sometimes they may not actually get the benefits from the deferred tax asset. So in the cases that it's more likely than not that the company won't realize some of the benefits from the DTA, it needs to end up reducing its DTA by the amount it expects not to realize. Instead of directly reducing the DTA, they'll reduce it by using a contra asset account. So in particular, they'll use a DTA valuation allowance. So all that means is you'll report your deferred tax asset or DTA at its gross amount. You'll subtract out the amount in the allowance, and that gets you out to your net balance in your DTA. Now before, when we looked at the journal entry for recognizing a DTA, we ended up debiting income tax expense. We ended up debiting a DTA, and we ended up crediting income tax payable. All right, so the DTA effectively reduced the amount of tax expense we recognize in the current period. If we expect not to realize the DTA then, that means our income tax expense will increase going into the future. Or the amount of income taxes we'll pay going into the future will increase. So if we establish a DTA valuation allowance, when we increase the allowance, it's offsetting our DTA, so our DTA, or our deferred tax asset, is decreasing. So an increase in the DTA valuation allowance. This means your DTA is decreasing, and so as a result, more taxes to be paid. A decrease in a DTA valuation allowance means your DTA is increasing, and so less taxes to be paid. Right, and so this concept right here explains the journal entry we're making. So if we're increasing a DTA valuation allowance, we're going to end up paying more taxes, so we'll end up recognizing more income tax expense. Right. On the other hand, if we're decreasing the DTA valuation allowance, that means we expect to get more benefit from our DTAs in the future, so that should reduce your income tax expense going into the future. Again, this DTA valuation allowance is contra asset, so to increase it, you would make a credit. To decrease, you make a debit. Let's just go through an example here. Let's say Scholar Corps has a deferred tax asset at the end of 2014 with a book value of $50,000. The company estimates that there is an 80% chance that $10,000 of the benefits from the DTA will not be realized, and a 20% chance that the other $40K of the income tax benefits from the DTA will not be realized. So in this example, a company is only going to establish a DTA valuation allowance if it's more likely than not, so greater than a 50% chance that I won't realize it. So assuming that there's no DTA valuation allowance balance, so it's just zero going into this year, we need to increase our DTA valuation allowance for the $10,000 that we expect not to realize. So to increase our valuation allowance, we'll debit the allowance to reduce DTA by 10 grand, and we'll debit income tax expense. Again, it helps to keep track of the allowance to reduce DTA. In some sense, this works kind of like your allowance for doubtful accounts, in that the journal entry you'll be making for this account at the end of each year will simply be the difference between the beginning balance and your desired ending balance. So let's just say it has a balance of 0 at the beginning of 2014. And then we want a balance of 10,000 at the end of 2014. So our plug number we made here was for 10,000. All right, so now let's go into the next year. Let's assume that Scholar Corps' DTA is still 50,000 at the end of next year. They reassess the likelihood of realizing the benefits, and they determine that their prior estimate is overstated. They currently estimate that there's an 80% chance that $3,000 of the benefits from the DTA will not be realized. Okay, so in this case then, at the end of 2014, or at the end of the next year, end of 2015, since there's an 80% chance that $3,000 of the benefits won't be realized, this $3,000 will be our desired ending balance. So to get from a $10,000 beginning balance to an ending balance of $3,000, we would make a debit for $7,000. Right, so this will be our plug number for 2015. Since we made a debit here to allowance our DTA valuation allowance, we'll make a debit in our journal entry, and then the balancing credit, as we went over, is going to be to income tax expense. So this next slide just kind of goes off on a tangent, and it covers the difference between statutory and effective tax rates. So a statutory rate is just a legally imposed rate. So for example, our top tax bracket is 40%. That's a statutory rate. The effective tax rate, though, is the rate at which income is actually taxed. So the difference here is, even though a statutory rate could be 40%, an individual or a company could be granted deductions, or they could have certain tax credits, which effectively reduces the amount of tax they pay. So the effective tax rate generally will be lower than the statutory rate. To calculate your effective tax rate, just take your income tax expense and divide by pre-tax financial income. So just an example of this, let's say Rice Crate Corporation has pre-tax financial income of $100,000. Of this income, $20,000 is interest revenue from a municipal bond, non-taxable. Right, the tax rate is 30%. So again, any interest revenue from a municipal bond is never going to be taxed. So in this case, our taxable income is going to end up being $20,000. Or sorry, it'll be $20,000 lower, so our taxable income will be $80,000. So if we take our taxable income of $80,000 and we multiply it by the statutory rate of 30%, we get up to $24,000. Right, so when we divide that by the pre-tax financial income, we get out to 24%. So in this example, even though the statutory rate is 30%, the company is effectively paying 24% because some of that financial income is not taxable. In all the examples so far, we just assume that the tax rate was constant. So in other words, we just use one tax rate for all years. In some cases, a company may be aware that the tax law is going to change in the future. So all that's going to happen is when they calculate their DTA or a DTL, they're just going to take their future taxable amounts or their future deductible amounts and they'll multiply it by the expected tax rate in those future years. In the case that a company is not aware that the tax rate is going to change and it just changes on them, they're not going to go back and change any previous year's calculations. Rather, they'll just use that new tax rate in the current period and onwards. So effectively, if a company deals with multiple tax rates or changes in tax rates, all that's going to happen is effectively they'll take the future deductible amounts or future taxable amounts and they'll multiply it by the tax rate in the each year, by the expected tax rate in each year. So let's just look at an example of this. Let's say Wiseman Corporation reports pre-tax financial income of $500,000 in 2001. Included in the determination of income are installment sales of $90,000. For tax purposes, installment sales are taxable when collected. So the collections are $30,000 in 2001, and then we expect $30,000 in both 2002 and 2003. Okay, so we have future taxable amounts in 2002 and 2003 of $30,000. So what if in 2001 the tax rate's 40%? But then it's scheduled to decrease to 35% in 2002 and 34% in 2003. So again, as always, first step, reconcile your accounting income to your taxable income. Of the $90,000 in installment sales, $60,000 will be collected in a future year. So taxable income will be lower than accounting income by $60,000. In the current year of 2001, the tax rate's 40%, so we'll use that 40% to calculate our income taxes payable. So we take the 440 of taxable income multiplied by 40%, we get out to 176. Again, that tells us we're going to credit income tax payable for 176. Now to calculate our future tax consequences, we're going to collect $30,000 of the cash from the installment sales 2002 and $30,000 in 2003. So we'll take these future taxable amounts and we'll multiply them by the expected tax rate in the year in the year we expect to collect this cash. So in 2002, we expect the tax rate to be 35%. So we'll take this $30,000 in 2002 multiplied by 30%. And then in 2003, we expect the tax rate to be 34%. So we'll take the $30,000 we expect to collect in 2003 and multiply it by 34%. If we multiply through, we'll get out to 10.5 and 10.2. We'll just add these future deductible amounts together, or the tax on the future deductible amounts together, and we're out to our DTL of 27. If we assume we have a zero balance in our DTL so far, that means we'll just make a credit here to the DTL for $2,700, which means our income tax expense is just your income tax payable plus the increase in the DTL of 27. So now let's modify that previous problem, but assume the tax rate's assume the tax rate is 40% in 2001, and at the time there's no indication of changes in the tax rate. So in this case, our income tax payable would stay the same. However, our future tax consequences, or DTL, would change. Right? As of 2001, we would still expect the tax rate to be 40%. So we're just going to take these future taxable amounts of $30,000 in 2002, 2003, we'll multiply it by 40. So in this case, our DTL would be get out to 24,000. Again, income tax expense is just going to be the sum of these two numbers, 176 plus 24, so we get out to 200,000. Okay, and then let's go into 2002. Now Congress changes the tax rate to 35%. The new rate will apply to 2002 through 2004, and pre-tax financial income is $600,000 in 2002. So in 2002, our accounting income $600,000. We're going to collect $30,000 of the installment sales from 2001 and 2002, so taxable income will be $30,000 higher, which gets us the taxable income of $630,000. At this point, the tax rate's been changed to 35%, so we'll multiply the $630,000 by 35% to get to our income tax payable of $225,000. Right. So for our future tax consequences, we still have another $30,000 of installment sales going into the next year. Again, tax rate's been changed to 35%, so we're just going to apply this new tax rate to this future taxable amount of $30,000. Right, so that got us out to a deferred tax liability of $10,500. Since we're continuing on from the first year, we would have a balance in our DTL currently of $24,000. We would now like a balance of $10,500. So to reduce our balance from $24,000 to $10,500, we would make a debit here for the difference of $13,500. This will be our plug number. Since we made a debit to the DTL account to get to our desired ending balance, right, we'll carry that through to our journal entry. And again, income tax expense should balance our journal entry here. So income tax expense will be the $225 minus the $13,500 decrease in our DTL. Okay, so just to recap, if there's a new future rate and we're aware of it, use those new future rates to calculate your DTLs or your DTAs. If tax law changes in a future year, you just use that new tax rate going forward. You don't need to go back and change anything.